And all right, 5, 4, 3, 2, 1. You're up.
Hi, Dusty Bates here with Brett Swarts, who is with Capital Gains Tax Solutions. Thought we would have a discussion about, there's a couple types of DSTs out there, one that you're probably more familiar with and one that's actually very useful that you're probably not familiar with. And Brett is a specialist on DSTs. And Brett, I thought we would talk a bit about what you do and a little bit about the DSTs that you deal with and the benefits of those.
Dusty, so good to be here, and it's awesome to be a part of the EXP commercial family with you. I had the pleasure to meet you, and I think it was Oakland, right? We did an event out
It was in
there.
Oakland. Yeah.
Yeah, and so that was really really neat, and love that you have your commercial real estate focus and expertise, and also thinking outside the box to bring great content like this. And so, yeah, we're going to be talking about a strategy that helps people to defer capital gains taxes, not using a 1031 exchange. In today's environment, it's more and more difficult to find deals that make a lot of sense cap rate wise, given that interest rates are going up. And so, by knowing this strategy, you're going to come out, I think, with more confidence to know that you don't have to force a square peg in a round hole. Meaning you don't have to overpay for properties, right? You can defer capital gains taxes and sit on the sidelines and be patient. And so that's sort of what we'll be talking about today. And we'll do kind of a webinar style. I'll share the screen, kind of walk through how it works, the legality, the background, and kind of the possibilities for all the listeners out there.
Okay. So DST, there's two types. What is the name of the two that we're going to discuss? Well, the one that you have, and then there's the other one.
Yeah, so there's one that's called a Delaware Statutory Trust, and that's more of the, I guess, traditional 1031 exchange way of deferring capital gains taxes, where you can actually sell a real estate investment property, and via a Delaware Statutory Trust, you can buy an interest in a kind of a partnership deal, if you will, with typically big corporations, where you 1031 into that. And we've done those, and those can be valuable given depending on the circumstance. But the one we really focus on, like our niche focus is the Deferred Sales Trust, and that's the one that most people don't know about, and they get it confused with the other DST. And that works for all things. It works for cryptocurrency, businesses, primary homes, investment real estate. And you're able to defer the tax via an installment sale with a trust based upon IRC 453. So we can get into all those details, but it's just a really flexible way to defer capital gains tax.
So a lot of people have, when you've got your business, you've got your real estate. Sometimes people will sell the real estate and do just a standard exchange into something. But the business portion, they tend to have difficulty that I've seen exchanging that. And you're saying a DST that you work with, these deferred sales trust could do that.
Yeah, exactly. So as it gets a great reminder, and it's like we got to remind ourselves that what tool actually solves the problem. And so the 1031 exchange only works for investment real estate. It doesn't work for business sales. It doesn't work for primary homes. It doesn't work for cryptocurrency. It doesn't work for public or private stock. It doesn't work for NFTs. It doesn't work for artwork or collectibles. Whereas the deferred sales trust works for all of those. Okay, and so that's important. As real estate professionals, we tend to think that all the wealth is coming from real estate, but there's all kinds of other wealth. In fact, there was a study done that, according to the American Bankers Association, there's about $32 trillion that's going to pass from one generation to the next in the next 20 years. And this is known as the baby boomers that are passing to the millennials, and it's known as the largest wealth transfer in the history of the planet. And in fact, there's 10,000 baby boomers turning 65 every day, and there's about 77 million in the U.S. alone. And 50% of the total wealth is tied to businesses, private equity, primary homes, and investment real estate. And out of those three, only the 1031 applies to investment real estate. But to be honest, where are you finding deals, Dusty? I'd pass it back to you. Like, what are you seeing with cap rates? What are you seeing with opportunities? With especially here, we're in California, especially that we're both, you're in the Bay Area. I'm in Sacramento, originally from the Bay Area. I mean, prices are crazy, Dusty. What do you think?
The prices are insane. There's no inventory anywhere right now. Everything's trading off market if you can get a hold of something. Most of what I've been doing is we trade multifamily into net lease properties like a Starbucks or Taco Bell. So like Bay Area, Northern California, the prices are so insane that you could sell your fourplex and buy a Taco Bell instead and raise your net income, get rid of all your management needs. And so that tends to be a good fit if you can find the inventory, but there's not a whole lot of inventory out there. It's very tough, very tight market.
Yeah, exactly the same thing. And that's part of what happened in the 2008 run up, right before the crash. People were overpaying for the 1031 properties with deals that didn't make a lot of sense, taking on too much debt, didn't have enough of the liquidity, and some of them got really hurt. And that's kind of how we started to really focus on the deferred sales trust and fell in love with the solution it can provide for people. One of the sayings we have around here, Dusty, it's no longer just about cash flow; it's more and more about tax flow. And to the extent that you're focusing on your tax flow plan and exit planning is so important, because it's not what you make, it's what you net. And then more than that, what you can defer and what you can earn on, which is the powerful thing. And the other thing too is estate tax, right? Most people aren't even thinking about this, but estate tax is a huge challenge for people that are worth more than 22 million married, 12 million single. Those exemptions are set to cut in half here in the next few years. And then they're looking at 40% of their total net worth, no matter if you have a stepped up basis, that has nothing to do with capital gains tax, is going to be hit with a death tax. And so the intent is to get the funds outside the taxable estate, but you can't get it outside the taxable estate. A lot of people in time without buying a bunch of life insurance or giving it all away to charity or gifting it. And so with the deferred sales trust, we can exit that and we can solve that problem. And I like to use this analogy of a Rubik's Cube, right, Dusty? Each and every day, we're faced to try to help our clients with apartment complex sales, real estate sales, cryptocurrency experts, primary home exits, business exits, and there's this challenge. And everyone has a little bit different cube with different challenges on it. And our goal is to just try to line up as best we can, all of the size to make it congruent for people who are facing these challenges, and hopefully the outcome as close as possible with the yes, there are two cubes, everybody. I didn't do this. Yeah. And so to be congruent, but you got to have flexibility, you got to have liquidity, you have diversification. These are foundational things to help you create and preserve more wealth and not be stuck in the old 1031 that sometimes can put yourself in a bad position. I still like 1031s if you can find a deal, but guess what? The deferred sales trust is a backup plan for a failed 1031 exchange. But again, at the end of the day, we're just trying to solve people's problems the best we can and bringing in experts to do that, such as what we're doing right now.
So, yeah, I've talked to my clients when we do these exchanges about having that as a backup. We've never had to do that, but it would be good to have that as a backup, not for just that, but there's so many, like you said, other stuff like businesses, other assets that can't be exchanged. Can you walk us through kind of how the DST works, what the process is, and someone who's not familiar, I'm not super familiar with it myself, but how would that work?
Absolutely. And in fact, I'm going to share my screen now so we can kind of go through this and you can see it, because I think visually it'll also help everybody to kind of get a feel for this. And I'm gonna fast forward to a couple actual deal stories to kind of bring this thing to life. And let me see if I can make this a slideshow, and let me see if that looks good. Does it look good?
Looks good.
Yeah. So who is this for? First of all, again, if you or your investor or your client have a asset that you're selling that's subject to at least $1 million net proceeds and $1 million gain, and it could be cryptocurrency, NFTs, businesses, investment real estate. It could be a failing 1031 exchange. Even if it's past your 45 days, no problem, as long as you're working with the exchange accommodators that will accommodate. We'll talk more about that later. It could be GP or LP interest, primary home, public or private stock, carried interest, captive insurance, artwork. It's got to have a big enough gain in order to have enough paying the tax. What's the tax? Well, it's somewhere between 30 and 50% of your gain. That's the capital gains tax depreciation recapture, depending on what state you're in. It might be a little bit lower if you're in one of those really, really friendly tax states. But that gain of $1 million was going to be subject to $250,000 to $500,000 of tax. And that's what we're trying to solve for, okay? And this is actually a deal that we closed for a client. And he loves multifamily investing and developing and building. And he actually had a different business he was selling. It was a marketing business. And he sold and deferred hundreds of thousands of dollars of tax, sold a business for $2.6 million. And that property, and then he ended up using the funds to purchase or build 72 multifamily unit ground up development, all tax deferred. And so the funds can be invested alongside you as an active investor on existing deals or ground up development, but no timing restrictions. He didn't have to run around with the 45-day shotgun wedding, our engagement, 180-day wedding. He's also able to defer the tax and invest some of the funds into the stock market and into hard money lending, and that's a really what's possible. Here's another one we did for multifamily syndicators that sold 2 apartment complexes. Now they've gone on to do 2 more. This is their first 2 they did with us, and they're closing our 5th one here in a couple weeks. So I think it's going to be over like 75 million total in assets that they've sold with us now. And they're deferring the tax. Now they're GP positions, so they have a bunch of LPs, and so not all of the 75 million is theirs. They're putting their smaller GP positions in. But a lot of commercial real estate syndicators we work with are feeling trapped by this capital gains tax when they go to exit, and a lot of them do not use the do not use the 1031 because it's too complicated to have all of the entity move. And so this is what they found. They just kept selling deals and paying tax. And all of a sudden they're like, why don't we defer the tax? And then, Brett, can we move the funds right back into another deal that we're already own and running? Yeah. So instead of having to raise more capital from a bank or another investor, we could use the capital that we would have paid a tax and build money on that. Yeah. And what's the interest on that? The government charges you 0 interest as long as your numbers are basically 5 million per person per year. And so it's just a mathematical equation. Once they understood that their problem was kind of looking like this, we found one solution to turn it into like a clear color for them. And that was really cool. Then we did with cryptocurrency, which is incredible as well. Over 12.5 million now under management. And the first one was done on August 7th. And that was really big. And again, this is not using a 1031 exchange, but in like 1 hour and 1 day on a random Saturday on my way to Walnut Creek, we stopped. I talked with him. He gave me all the nuclear codes, and he exited $5 million of Bitcoin and Ethereum, deferred 1.85 million of tax, all without using a without using a 1031 exchange, using a deferred sales trust. So it's pretty amazing what it can do. And the question is, how does it all work, right? And that's where I'm going to walk you through that. There's a ton of other deals. We did a primary home sale in Palo Alto for 8.3 million. Here's one in Colorado, multifamily sale for 5.1 million. Here's a Sacramento property. We saved a failed 1031 exchange, multifamily for 3.1 million. So let's talk about how it works. And let's see where this is at. Actually, it's on the other presentation. Now, in the meantime, let me pull that up. I'm going to give you a story about giving you some clarity on the legality, even before we go for how it works, since my slide is on another slide. So the biggest question we have, Dusty, and most people at this point, is they say, Brett, this sounds amazing, but it sounds too good to be true. Like, I need my trusted advisor to say yes. Like, I don't understand why my really smart, sophisticated CPA didn't tell me about this. It doesn't, or even maybe doesn't even know about it. Or I called him and he said, I'm not sure that I would do it because I never really heard about it. I'm not sure if it's going to work. And you can't blame them, Dusty, right? Yeah. They're not going to advise on something that they don't know about or they've never done themselves. It's like going to a doctor to replace your ACL. And he's like, Dusty, I'm not your ACL surgery. I'm not a knee guy. I'm your general practitioner, right? So I'm not focusing on highly appreciated exits. So some people too often, they think their CPA is going to know all 10,000 pages of the tax code. Now, the creator of the Deferred Sales Trust is a CPA and a tax attorney, and he's the creator of the structure. We call him the Bill Gates of tax deferral. So it's not as if we're relying on people that aren't professionals and know what they're doing. In fact, that's why I'm going to tell you this story right now, tell you one deal story to hopefully instantly help you gain credibility, even if you have no deferred sales trust or tax deferral experience. And this is the story. It's a gentleman named David Young, which in commercial real estate world that we're in, Dusty, we don't necessarily know this gentleman's name per se. Like, I didn't know it until I was in the deferred sales trust world, but it's sort of like a Mark Cuban, right? Would be for an entrepreneur company or businesses. That's kind of like a David Young is for, in the essence of financial advising or money management, or he's an economist, and he actually ran with a guy named Bill Gross, and you might have heard of Bill Gross. Bill Gross and David and about 4 other guys built PIMCO, and PIMCO is one of the largest money managers in the world. And so David was a former executive VP at PIMCO, and he gets approached with the Deferred Sales Trust about 4 years ago. And keep in mind, he manages money and helps with financial advisors manage some of the biggest wealth in the world for very, very, very sophisticated, smart people. And you can also imagine that a lot of people come to him trying to have him sell their thing, right? Their tax referral thing, their whatever, to get access to his clients, to get access to his knowledge, all of these things. And so they're very skeptical and they're cautious. And by nature, that's what they do. They do due diligence on business. They although they're not tax attorneys or CPAs, they do due diligence on these things, and they work with really smart people. So anyways, long story short, 4.5 years ago, he gets approached with the Deferred Sales Trust. He's like, wow, this sounds too good to be true, but he was open-minded enough to look at it. He doesn't do a 2-day due diligence or a 2-month due diligence. He does a 2-year due diligence, Dusty. 2 years. And he has his legal team look at it, and their legal team look at it, and they fly back and talk with the different clients, fly back and talk with the tax attorney, sit down for 2 days with the tax attorney, who's my business partner, map everything out on a whiteboard, and they're going through all this stuff. And they're talking with financial advisors, the banks, and they're methodical about this, right? Because if it's true, it's a game changer, right? And they came through with 2 conclusions. Number one, that might be the smartest person we've ever met. This is after their 2-day intensive with the tax attorney and their whole team. Number 2, we're all in. We'll put our name on this, and they became a part of the Deferred Sales Trust inner circle, and they're part of the new asset allocation advisory team. And every single Deferred Sales Trust client of Capital Gains Tax Solutions has the opportunity to work with David and his team. Now, David and his team are typically taking very large accounts, but no matter what the size of the account, you can work with David and his team. Now, David works with the financial advisors that we work with across the country. We have strategic alliances, so it's like a team effort here, right? It's not just David. We get the entire team, but you work with the financial advisor that's typically local to you. But here's the question, Dusty, and I'll just start it right here before we go into the how-to, is if it's good enough for David Young and his legal team after 2 years of due diligence and him being in the business, I call him a Hall of Famer, a world-class financial management professional, is it good enough for me, Dusty, and whoever's listening to this, and potentially any CPA that's considering this?
Yeah, the Mark Cuban of the financial advisor world. Yeah.
Yeah, I mean, that's the thing. So it's one thing to hear Dusty and Brett talk about it. We're commercial real estate brokers who help our clients defer tax, sell deals, exit properties. And now I'm a deferred sales trust. Is what I'm doing here every single day, helping people solve these problems as a trustee and helping clients do this. That's one thing. We have our opinions, but when you have world-class professionals that putting their name on this, these are very serious people, and you can talk with David. In fact, you can see his entire podcast episode where I interview him on basically overcoming the false beliefs of the Deferred Sales Trust. The false beliefs if it's too good to be true. How do we know it's legal? Where and how can the funds be invested? How much flexibility do we have with all of these things? And you can share his story also of the value of the Deferred Sales Trust in times like this, which I think is very timely. He's been on the show about 5 or 6 times now. And also you can go to capitalgainstaxsolutions.com to learn more about that. But that being said, I'm gonna push it back to you, David, as I'm pulling up the how-to page. Any thoughts or questions on anything I just said?
Yeah. So the probably some questions that an owner would likely have is, do I have to defer out my business? I can't use my CPA or my financial advisor. I have to use theirs for these guys, or do they work with their own, like an investor's CPA or financial advisor? Or do they have to trade them out for these guys? Yeah,
great question. So as long as it's not a related party, like Dusty, if you wanted to set this up and you're like, and it's somebody that's related to you directly. We work with financial advisors across the country. The way it typically flows, though, it's kind of like a real estate deal. If someone's bringing the deal to somebody and educating them and showing him and walking him through how to make it all work, right? Then we're going to stay loyal and work with, that financial advisor with that client. You know what I mean? So that's typically the process which we go through. And as far as their CPAs, yeah, they keep their CPAs. I mean, their CPAs are their CPAs, right? And they're going to do their tax returns. We don't do tax returns. We're not focused on that. We're focused on the Deferred Sales Trust. So we're very friendly to other CPAs. We're not competing with them. So yeah, they keep their CPAs. They're welcome to have their CPAs come in and sign an NDA. And then when they sign the NDA, we'll go through everything, all the nooks and crannies and the details. And I'm telling you, 9 out of 10, if they just spend time with us, and if the client is doing a good job of making sure that the CPA is in the passenger seat along the journey of exploring this, and not in the rear view mirror just going 100 miles an hour and asking them to, rubber stamp it as they're closing in 2 weeks and they've never heard of it, right? It's like you can't blame the CPA for being very cautious and concerned because they don't want to put a name on something they don't understand or have been a part of. So ideally, you hear this information, you get with your CPA now, you're doing your pre-planning. Even if I'm selling 6 or 12 or 2 years from now, Britt, yes, we're working on deals that are years in the making, right? We're pre-planning and building this out. Do you pay us anything prior to closing? No. We actually only charge at closing. If for any reason you don't use the trust, do you pay? No. So we try to take the pressure off of everybody to get educated and to make a clear decision on that, if that answers the question, Dusty.
It does. That does. That's great. I'm interested to see, you were talking about failed exchanges. You can come in after the fact or as they're failing and help people out. That is very interesting because that's always at top of mind, right? You get 45 days. That's the fastest 45 days of your life to ID something. And
yeah. Let's go through that. It's kind of like, what's the biggest frustration with a 1031 exchange? It's this shotgun wedding where we all have friends and family who got married, too quickly, perhaps, right? Maybe could have took their time a little bit better. And the outcome sometimes is not great. And that's kind of like the shotgun 1031. I call that blockbuster. In fact, it's one of the reasons I started the company, because in 2008, the market crashed and I saw friends, family, and clients lose half or everything over the next couple of years. And the number one thing we could identify is that they had 1031 exchanged. They had overpaid for property that they knew they were overpaying for. They had too much debt, not enough liquidity. But the biggest thing is they felt trapped by that capital gains tax. That's why they did the 1031. They felt they had no other option. And so at the end of the day, what we like to provide, and we believe everyone deserves, is freedom from capital gains tax. That doesn't mean you don't pay it. It means you can defer it. But it means also freedom from the 1031 of having to overpay for a property that doesn't make any sense given the interest rates, given the cap rates, given like cash on cash returns right now, and also what happened in 2006, 2007. In fact, one of the best stories for that is called the Monday morning quarterback. And I'm gonna share my screen again to go kind of give you a side-by-side comparison of the 1031 exchange versus the Deferred Sales Trust. And This was incredible because this particular client, he was making all kinds of money in the real estate business. In fact, he's doing 1031 exchanges, he's building wealth, and he is really smart. Okay, hundreds of millions of dollars, and he looks around. This is 2006. It's his 1031 binoculars, and he's like, "Whoa, it looks scary out there." Like he didn't know '08 was going to happen per se, but he knew something was going to change. It had to, right? And so for the first time ever, he decides not to do a 1031, and he takes a chance, if you will, on this Deferred Sales Trust, something that his advisors didn't know about. He's learning about for the first time. All the things that everyone's probably thinking about right now. And he puts it into the Deferred Sales Trust. It's a $20 million asset in Minnesota that he sold. And he put all of his funds into liquid investment grade securities, and he just waited. Now, he also protected and hedged it. He wasn't going for home runs there. He was looking to keep his capital preserved. So he wasn't going for outstretched returns. And so even when the market crashed there, he was protected. There's ways to do that, by the way, with really smart financial advisors that we work with. That being said, he gets a call from the bank. This is 5 years after he sold it. And the bank says, "Hey, do you want to buy back the building that you sold to that buyer? Because we just foreclosed on it." And he goes, "Well, maybe. What's the price?" And he goes, the bank says, "Well, about 60 cents on the dollar." He goes, "About 40% less than what I sold it for to that 1031 buyer?" Yeah, give me a couple days. So within a couple days, he had reallocated some of the investments with the financial advisor and put some of the funds into an LLC, of which he then partnered with this LLC and purchased the property, all tax deferred. Still hasn't paid $1 of tax at this point. Okay. So he sold high and he bought low, right, Dusty? And I heard this story and my brain's exploding because at Marcus and Millichap, we thought we were the Navy SEALs of investment real estate. We thought the 1031 exchange, we thought Blockbuster was always going to be in, right? But all of a sudden, this Netflix Deferred Sales Trust comes in. And most people, and even us, we were very cautious and concerned. But I'm going, if this is possible, oh my gosh, he didn't have to go into debt. He didn't have to overpay. He could sell high and buy low. He can diversify. It's Netflix. Like, this is what we can do. So the Deferred Sales Trust is the Netflix way versus the 1031 Blockbuster.
So I can sell my property. I've got someone with some Rite Aid. I've got a gal with Vineyard. Their concern is they're going to trade sideways. Okay, I'm going to sell this. I'm going to buy something else, and in exchange, maybe that's great. Maybe that's okay. But you're saying we could have them offload from the Rite Aid, for example, park their money, as it were, in something else, and then trade back into real estate when the time's right and defer the taxes?
100%. Absolutely.
Wow.
Yes. That's exactly why we started the company. It's exactly why we're here. It's why we're so passionate about educating literally everyone who will listen, who will get with us. That's why we've got the book coming out with Kevin Harrington from Shark Tank. He'll be a part of the book. It's called Building a Tax Deferred Exit Strategy, and all kinds of other really smart multifamily syndicators in this and financial advisors. It's why we're here. And so once you know Netflix, once you know Amazon versus Circuit City, right? Once you know, the new Uber versus taxis, right? Like, why would you ever do a 1031 ever again? I mean, the answer is 1031 is cheaper, right? And you know it. And if you can find the deal, we'll give you the high five. Like, remember, we can save a failed 1031. And so you can go for your 1031. You don't pay us unless you close on the Deferred Sales Trust. So we're not taking that away. We're just giving you an option and an alternative. But exactly right. I mean, I think you really got to define again, what problem are you trying to solve, right? So most of us as commercial real estate investors and brokers, we're typically only focused on just capital gains tax, which is the tiger by the tail, right? It's the 25 to 50% capital gains tax. But what if we live in California, like my client who sold their $5 million property in Colorado, and they had no basis on it, and they're worth $25 million, and their challenge is not just capital gains tax, it's also income tax, and it's also estate tax, right? It's those three things combined. And they're saying, the 1031 exchange doesn't solve my income tax, doesn't solve my capital gains tax. I mean, it does solve my capital gains tax. It defers it at least. But it doesn't solve my estate tax. That's 40%. Now, all 25 million was inside their taxable estate, and they're still relatively young. So it's going to grow, and they know those exemptions were going to be cut in half. And so in one day, in one transaction, we eliminated their estate tax. Okay. So what's 40% on 5 million? That's 2 million eliminated immediately. Okay. Number two, we deferred their income tax. They delayed payments from the trust. And so the trust is able to earn proceeds and build inside of itself, and not pay tax on this trust level because it owes it to the client. And the client is able to sit back and still live in California and not have to receive that income because they don't need it right now. So it's still their money, still earning interest, still building, but they're deferring the income tax. And as well, they're deferring the capital gains tax. And so you combine all those things. And again, if this is the problem they're trying to solve, the 1031 might solve one side, but what about the second side and the third side? I'm just holding up in a Rubik's Cube for those who aren't listening. Like, there's more problems to solve. And then the next thing would be a new depreciation schedule, right? We're taught to buy property, do cost segregation, depreciate it 27 and a half years on multifamily, 39 years commercial, because that's a way to offset the cash flow, which is a beautiful thing. Well, what happens if you run out of depreciation? Well, in a new 1031 exchange, your old depreciation schedule travels, so it's just not good. With the Deferred Sales Trust, you can get a new depreciation schedule if you're active with the trust, which is powerful.
You can get a brand new depreciation schedule.
Yeah. Now, you only get up to 80% of it, just so you know, if you're active. So remember when I talked about the client who bought that property back out of foreclosure? Mm-hmm. Right. And my other client who built those multifamily units? Because it's not 1031 money, it's actually new capital, fresh capital that's going into an LLC. You can get a new depreciation schedule, which is really great, right? But all of this, here's the key. This is the one foundational truth with what we're trying to get across to everybody. It's optimal timing, okay? The 1031 exchange is your friend for tax deferral, but it's your enemy for timing. The Deferred Sales Trust is your friend for tax deferral, but it's like your savior for timing. I mean, it's literally no timing restrictions. There's no 45-180. There's no like-kind requirement. There's no debt replacement requirement. And this is why it's like Netflix. Like, why would you ever go back to Blockbuster if you have all of these flexibilities, right? Then you also have diversification, liquidity, and it's just remarkable what it can do. But again, most people don't know about it, or even then, like, your brokers Most brokers, unless you're working with like a Dusty who's out thinking outside the box, they don't want you to know about it. They don't even want to know about it. Like, because I've been a broker, right? And I've been in their shoes where we get paid on these 1031 exchanges. This is also why huge commissions, right? This is also why exchange companies typically don't want you to know about this, right? In fact, some of them are adamantly against us, but although we have a perfect track record, thousands of closes, billions under management, over a dozen no change IRS audits, 26 years, like literally it's been perfect. The biggest deal in California closed, 125 million. Like it's never lost because we do everything in the right way and we do everything for all these legal technical things, but they don't want you to know about it because they want to keep you in the 1031 exchange, right? Where they get paid. Whereas the Deferred Sales Trust is the Netflix, and that's why we want everyone to know about it. So,
you were also saying about this helps with the estate. It seems like it solves everything, like the estate tax too. You can help.
It eliminates the estate tax. Yeah, eliminates the estate tax. So that I wouldn't say everything, but estate tax it definitely eliminates. Whereas remember, if you do a 1031, you get a stepped up basis. I'll give you an example. Let's say you're worth $52 million right now and you're married, Dusty, let's imagine, right? And in all 52 million inside your taxable estate and all 52 million in one apartment complex, just keep it really simple. Okay. And you die tomorrow and you bought it for 20 million, right? And so your kids, and say you had two kids, your kids get a stepped up basis to 52 million and you're like, oh, high five. Everyone's been taught. Drop into your swap, right? Well, guess what happened? Mom and dad, Dusty and his wife didn't put it outside the taxable estate. So Johnny and Jill, the government wants their money, 40% of anything above the exclusion. So let's just say 22 million is excluded, 30 million is the amount that's not excluded. Well, what's 40% of 30 million?
Yeah.
It's $12 million. All of a sudden you're like, what? Why have everyone been preaching this, 1031 drop into your swap? Just drop into your swap because they're thinking about capital gains tax. Now let's take another scenario. Dusty learns about the Deferred Sales Trust. Dusty is like, oh my gosh, Brett, I have an estate tax issue. I can either buy a bunch of life insurance. I can try to give it all away to charity. I can try all this. I can try to gift it to my kids, but I don't have the time. I don't want to give it all away to charity. I don't want to buy a bunch of life insurance. What can I do? Before you die, it's really important. We set up the Deferred Sales Trust. Then you sell it for fair market value, let's say at $52 million. Okay. It goes into the trust. It's called the DST 2.0. It's outside the taxable estate. A couple of years go by, whatever. The next day, you die. We've eliminated that $12 million estate tax. It's no longer an issue. It's outside the taxable estate, right? So that's the power of the Deferred Sales Trust.
That's awesome. Now, there's so many. I've got several people I need to introduce you to right now.
Happy to help.
Now, is there anything you have that we could walk through the process by which a DST?
I promised we'd get you there. Now that I have my my proper presentation, the one I had prior, I had up, it was my short version, right? Because sometimes I only have about 10 minutes or 15 minutes to go through this. But let me go through the how-to of this, okay? So it's right actually right here on this presentation. Oh, here it is. Okay. All right. So let's do a deal we just did in San Diego. It's about a $13 million deal, okay? $13 million deal. And this one closed just 2 weeks ago, and we were recording this as of May 17th. So it closed around May 1st, 2022 for $13 million. Their basis was approximately $4 million. Their debt was approximately $4 million. Okay, debt. So their tax liability was, let's see here, 13 minus 4. It was about 9 million of gain. So in California, state, federal, and Obamacare, it's about 40% total. So we're trying to solve for $3.6 million. Okay, now keep in mind, these gentlemen are real estate developers. They develop car washes, okay? So they're not in the business of selling high at $13 million and buying a $13 million car wash. They're in the business of buying land for like $200,000 to $500,000, improving it $3 million, $3.5 million, having a basis of $4 million, running and operating the business, and then selling it off in a couple of years. Okay. So they weren't even planning on doing a 1031, nor did they want to do a 1031. They're also partners that wanted to kind of maybe go their separate ways a little bit, right? So they call me, and this is 30 days ago. This is about April 1st. And like, Brett, we just saw you on YouTube. Oh my gosh, what you're saying sounds amazing. Sounds too good to be true. But if you can pull this off, we've got about a $3.6 million liability that we're trying to solve for. So what do? Well, step one, we form a trust. We form a trust for each of the partners. They each had their own trust. There's three of them. Now the fourth one ended up just paying his tax. He was like, I just want to pay my tax, and he just wanted to go. So he paid his tax, and so there was three partners left, and they had the buyer on ready to sell it for 13 million. Okay, and the buyer has the 13 million. He comes with cash, or he could come with a loan. It really doesn't matter. We're just not going to finance the buyer, but we're going to ask the sellers and the buyer to cooperate, which doesn't make any difference to the buyer, but it makes a huge difference to the seller. And we actually sold the assets or assigned the rights of the LLC that own the assets to these trusts prior to the close of escrow. So at close, the asset actually ends up selling to the ultimate cash buyer after it was sold to the Deferred Sales Trust. And long story short, the $4 million gets paid off. There's about $11 million in the DST, and this $11 million is due back to these three partners. Now this is a little bit less, I think, because the one partner went out. But essentially, the owner took a promissory note. The three partners did due at 8%, and they did 100% financing. Okay. So they took a zero down payment, and they received a promissory note to keep it simple, 11 million, right, minus the debt of 4 million on 13 here. It has an extra 3.6 million that's in a deferral state that's being charged 0%. Okay, so I'm going to pause there.
Okay.
Any questions?
Okay. I'm trying to keep up. So we sell we have the asset in an entity. Do you have to change the entity that it is traded into a different entity before you?
No, we just assign the interest, or to literally just sell the asset to the trust prior to close, just depending on the structure of what it is. This one happened to be an LLC, so we just assign the member's interest into the new trust prior to close.
Okay, so the trust buys the asset.
Exactly. Yep.
The money from the sale or the proceeds go to the sellers.
Mm-hmm.
And that is not a taxable event.
Yeah, let me walk through this too. So you see 11 million here. That was the net proceeds into the trust, but they actually bought it for 13 million, the trust, and sold it for 13 million immediately. So how much gain, Dusty, does the trust have if it bought and sold for the same price?
Oh, zero. Yeah.
You got it. Okay. Now here's the key. The seller, he received a 0 down payment. So the sellers owe about 3.6 million, but if they receive 0 today, how much tax do you owe on 0 if you receive 0 today, Dusty?
So you're financing the sale.
Exactly.
Is what is happening.
You're becoming a lender. Yep.
That is it. And it's a 0. So you're basically doing a 0% loan.
Not as 8% loan as the interest, but you're a 0 down payment. And by the way, you can take some payment at closing and just pay your tax on it. But it would be like carrying paper 100% financing for somebody.
Wow.
Now, you wouldn't do that in a traditional sense, Dusty, but you understand the concept, right?
Yeah.
If you did 100% financing, you're in a deferral state. Now, the interest payment you'll pay ordinary income tax on, but the other amount is in a deferral state. The difference here is we can secure the collateral against all kinds of stuff. The biggest companies in the world, Costco, Netflix, Google, Apple, right? You can put into hard money lending. You can put into other real estate assets, passive or active. That's the beauty of the way that we can diversify. We don't want to over-concentrate, and it's based upon their risk tolerance. It may not be 8%. Some notes are structured at 7%, 6, 5, or 4, based upon their risk tolerance and what the client's needs are.
Wow. That is awesome.
So that's how it works.
Yeah.
And so people might want to know what the price is or the costs are. We can go through that if you think that's good.
Sure. Well, I did want to. So assets, obviously, the real estate is one thing, but so we have businesses, um, cryptocurrency, et cetera, would kind of function the same as that asset portion, where you take the interest in the cryptocurrency and then trade it into the trust.
Yeah, and so this is our one of the things that we're most excited about. Although cryptocurrency has taken a big hit, but this is also the reason why the Deferred Sales Trust is perfect for cryptocurrency, is because you can exit cryptocurrency at a high and buy back low, and it's a very similar process, and that you actually transfer the coin to a brand new Deferred Sales Trust. We use Kraken as our main one account in exchange for a promissory note. The trust ultimately sells it to cash, and then from there it goes to the Deferred Sales Trust account. But it's the same kind of concept. You're basically transferring. You're not selling. You're transferring, but the trust is selling, and therefore it's in a tax deferral state. If it's like a decentralized coin, then we form an LLC and we have an assignment of an LLC, and then from there we're getting it back to Ethereum, and then like a coin that's tradable on a marketable like a Coinbase or a Kraken major crypto exchange, and then we do the same process. And so it just depends on the situation, but yeah, we've already done 2 of these now or 3 of these now, and we're set to do a lot of other ones, but we think that cryptocurrency is the best. The Deferred Sales Trust is the best opportunity for cryptocurrency investor millionaires that want to exit and want to diversify and don't want to get stuck in the highs and the lows because of the tax consequences. We just did one for a former tech employee for a big tech company. She bought Bitcoin for 30 to 50,000 and it went up to $50 million when Bitcoin was 54,000 a coin, and she exited 5 million of that 50 million at that point. And she plans to do more in the future as well.
Wow, that is awesome. So I understand, I guess, how that process works. There's a lot of probably clockwork to that, but I guess kind of the high level understanding I get. I don't know what else we should discuss in that realm for now. What do you think?
Yeah, I think we should just cover fees and then give people a call to action to get connected with Dusty. And then if you want to, you're seeing this, get connected with Dusty, and then Dusty can connect you with me, and we can kind of all get a feel for your situation. But yeah, the fees are about 1.5% on the first million, and then 1.25 on anything above. That's a one-time fee that you pay to my business partner, the tax attorney. So let's say it's $1 million crypto exit. Okay, you pay 15,000 one time, and then recurring fees are about 1.5% up to as high as 2, depending on how and where the funds are invested, and also depending on your actual net proceeds. So the higher that goes, the lower that goes. So it'd be about 15 to 20,000 on a recurring basis. That's how I get paid as a trustee. That also includes the financial advisor. So those are kind of the general fees. Now our goal is to net you typically about 6, 7, or 8% on your money, net of those fees, those recurring fees, not net of the one-time tax attorney fee. So that's why we have our minimums. Our minimum is 1 million net proceeds, $1 million gain. And as long as you're not needing to spend the funds on a primary home or like your personal use, which is taxable, as long as you're going for investments like crypto or real estate or securities investments or business ventures, that's where we know it's a home run. So yeah, if you can qualify there on the $1 million net proceeds, $1 million gain. Now, Brett, what if some people say, what if I have 20 coins that are $2 million? Well, we can crypto. We can work with that. If it's like, well, I have 20 single-family rentals at $2 million. No, that's too small. We need about $1 million net proceeds, $1 million per transaction, unless you have 2 or more at 5, or at least you have 2 or less at 500,000 each that can combine to that million. So that's kind of our math, and we do this all no cost, no obligation review of everything. That's why we set all of these minimums. We only get paid at closing. We've done enough of them to know which ones work and which don't. So yeah, you can go to capitalgainstaxsolutions.com to learn about that. And then you can also get with Dusty by checking out his YouTube channel. Dusty, it's Apartment Doctor, right? Apartment Doctor?
The Apartment Doctor, yeah, on YouTube. Yeah.
Cool. And then what if someone wanted to find you or email you? Where would they find you?
They could download the ebook that we have, which is the retiredinvestorbook.com. Basically doing what we talked about outside of this, which was trading multifamily into net lease properties. It just talks how to do that. And it's got all of my information there too.
Fantastic. Dusty, anything else before we go?
No, I think that's it. I think that covers it. And this is a great, I don't know if I'll do exchanges anymore. I think we might just talk to you guys.
Yeah, give us a shot. We'll give you the Netflix, right? And versus Blockbuster, and you'll see if it's a good fit for you. So we'll appreciate everybody out there. By the way, check out the new book coming out, Building a Tax Deferred Exit Strategy, the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. And check out our free mastermind masterclass on the Deferred Sales Trust by going to capitalgainstaxsolutions.com. Hey, thanks everybody for watching and listening. Please rate, review, subscribe to our YouTube channels, and share this with somebody. It could really help today.